We begin with a big bank breakout on the day the S&P 500 ended in the red. Check out these moves from Citi, Bank of America, Wells Fargo, JP Morgan, all firmly in the green. But wait a minute, it was just a few days ago that rates were plunging, yield curves inverting, cats and dogs living together, and now look. So have the banks turned a big corner? Guy.
I don't think
like this desk, by the way, cats and dogs living together, Guy.
Well, is that what?
I don't know.
You know,
sorry.
If you would be a cat or a dog?
Oh,
I'd like to think of myself as a dog. I guess.
I mean, well.
It's not a good question to answer on TV.
Well,
anyway.
you brought it up.
Let's go to the market, please. Sorry, that's my fault.
Please.
I don't think they've turned the corner at all. But what I think's happened is everything got a little ahead of itself. And it's not like we haven't talked about this. We're not saying this in a vacuum. You go back to Tuesday, I think, before Memorial Day, we actually power pitched some of the banks. I think specifically it was Citi saying that, you know what? Boring market, slow week, into a holiday, market's probably going to rally. The TLT's probably gotten ahead of itself. When Citi trades at that discount to tangible book, historically over the last couple of years, it's been a buy. And that's pretty much what's happening. I mean, I don't think, again, the landscape has gotten better for the banks necessarily. I just think the trading landscape in the short term has. So does Citi have more room? Yeah. Probably will overshoot to 72 like it undershot to 61. But I think the headwinds that they faced still exist today.
There are some rays of sunshine based on what the CFO told the Barclays Financial Services Conference today, that they expect growth in the back half of the year, that there are other parts of the business that can offset some of the losses or the softness in sort of the rate-sensitive businesses. And so can you sort of extrapolate that to some of the other banks thinking maybe things aren't as bad as people thought?
Yeah, I think that what the prices they were trading at before 2 days ago really reflected a lot of bad things. So I don't think, more than a lot of bad, too much penalties there. I think if you think about where Citibank was trading, well under 10 times earnings, a 3% yield. JP Morgan, 10 and change times earning, a 3.5% yield. Bank of America, under 10 times earnings. I mean, that's a lot of bad news priced in. And their business models aren't all interest income, right? There's a lot of other income in there as well. So I think, the market just saying, oh, the whole book of big money center banks is a giant 2-year, 10-year spread, it must be going to zero, didn't make sense. I'm not selling them here. I think they're still attractive.
So I'll answer the question because we've had one kind of from a market positioning and technical perspective. Karen's talking fundamentals. I'll talk to you the context of the overall market. You can make a comparison to the first quarter of 2016 when we were worried about global growth and banks essentially got through this period where once we got this sense that if recession was off the table, banks went on, arguably a very historic run for them relative to at least this cycle. Citibank's up 13% in 8 days. It's up close to 16% in 16 days. If you look at the XLF, it's basically kept pace with the S&P despite all of the things that have happened to banks. So the most important thing that happened today, and I hate hyperbole, May, but I will tell you, I think this was one of the most extraordinary trading days of the year that no one's talking about. S&P was flat, and yet you had banks up 3%, you had XRT up 3.5%, you had transport. This is a major structural day for the market.
It's not about the banks. It has nothing to do with banks, right? It's a behavioral thing. What we know is if you look at the S&P 100, what was the best performing stock? The more beaten down you were, the better. You were Schlumberger led. You've got Simon Property. You've got things like, Heinz, which is literally down 80%. GE in the top 10. So it's not a bank story, although it is that's part of the story because they matter the most. It's simply dead cat bounces. And dead cats do bounce. But do they really come to life? No, they're still dead.
But I would say, Carter, but it was more about deflation isn't as bad as you thought. I'm not going to tell you that deflation, because I believe there's some structural stuff that's left over from the crisis. But deflation, as it was exemplified and illustrated through bond yields around the world, through gold going through the roof, through everything else that was related to asset reflation going through the floor. The things that rallied today are asset-based. They're reflationary-based, and that's very exciting.
These are retailers that won't exist at some point in 3, 5, 7, whether it's an Urban Outfitter, an AEO. And it wasn't specific to banks. The fact that it was Kraft Heinz, there was Schlumberger, it was GE, tells you it was just an unwind of momentum.
So there's two sides here on this side of the desk. Extraordinary trading day or just dead cats bouncing?
Yeah, I mean, Tim makes an extraordinary trading day in terms of the move in yields terms. Everything that he pointed out was extraordinary in the context of what we've seen. But I tend to sort of, it should come as no surprise, I tend to agree more with Carter Worth. I do think these are bounces within the framework of things that have just been too oversold. I mean, you mentioned Simon Properties. Go back and look where it bottomed out in April 2018. Look where it recently bottomed out so you can understand the bounce. Schlumberger has been left for dead. I mean, we've talked about it seemingly for a year and a half, trying, at least I have, tried to ascertain when the bottom would be unsuccessfully. We've seen moves like this before in SLB. So, again, I guess the fact that the S&P was unchanged today, bulls could say what, that's somewhat constructive. Bears can say it should have been up 25 handles on a day like today.
The other flip side of what happened today was growth at any price, which had been where everyone wanted to go no matter what. Terrible, complete reversals. If you look at names like CrowdStrike or Zoom, right, just absolutely getting annihilated today. So it was just a giant rotation. It was just everything that didn't work, now let's pile into that. Everything that did work, time to bail.
But the question is,
does that continue?
Exactly.
I can't be in a CrowdStrike or a Zoom. They're too expensive. They were too expensive 2 days ago, even down 10%, too expensive for me. I think when momentum goes out, those kind of names have more downside.
But it's maybe more interesting. It's not terribly surprising that a CrowdStrike and company and their ilk are going down maybe on a day like today or just not rallying as much. What's been interesting is that Google, Amazon, anything that's been defensive, relative momentum, but actually, they tend to be low momentum stocks in difficult times in the market are underperforming. And so Carter's right to talk about Schlumberger. I mean, I don't think anything changed with Schlumberger in the last week. In fact, I think Schlumberger's got some tough times ahead of them. But when I look at some of the other parts of the market, including the transports, that are very real companies that are not going out of business, that I don't think they're dead cat bounces. I'm not saying the world has gotten better in 2 days. I'm telling you that it's always about positioning. It's always about where I think the market momentum is. We've got an ECB meeting coming up in a few days. It's also going to, I think, help tell the tale of where global yields go, because I think that the European Union is the one that was dragging global yields down.
And we know that the machines, momentum is on both sides. You have momentum down in Schlumberger, momentum up in a FICO. And when it flips, it's you get these levers going on both sides. But it doesn't usually last that long.
At what point do you think, I mean, would you
It would
be
take
convinced?
a lot of time and a lot more of this kind of thing. Because we saw it in the EM bouncing, we saw it in the certain ETFs.
Small caps are bouncing today.
You just need a lot more of it.
I agree. Carter's right. I don't think anything can. You can't say suddenly it's all good for all these things that have underperformed for a long time. But for the last 3 weeks, we've seen the DAX outperforming the S&P. We've seen emerging markets outperform. So this isn't a one-day phenomenon. Today was a bit of an exclamation point on things that really suffer from deflation.